So hello, I am Sharon Rice. I'm the Director of Norton Parks and Rec. Thank you all for coming out tonight. This is the first of what we hope will be a monthly series on financial literacy. We are very lucky to have Colin Habig here. Colin is a longtime Norton resident and now a financial advisor for Edward Jones. So he'll be here to talk to us about the basics of investing, the nuts and bolts, explain some terminology, how to think about it, and how to get started if that's what you want to do. Tonight is a no-sell night, so he's here to educate strictly. If you have questions, if you'd like to meet with him personally, he has a sign-up sheet here. Please sign up. No obligation there. We do have some refreshments in the back, so please help yourself to that. And just to let you know, our next seminar will be on March 31st, 7 o'clock right in this room, and the topic is preparing for retirement. So without further ado, I'll turn it over to Colin. And
thank you so much.
Thank you.
So I just want to thank you all for coming tonight. Sharon and I have been extremely excited to jumpstart these seminars. Growing up in the town, I never saw anything that was anything related to what I'm going to be able to do here. So I'm happy to answer any questions that you guys have. I grew up in the town. I've been here for 20 plus years, and I'm just happy to be here and help educate all of you. Unfortunately, we were not able to get a screen, so I'll be working off my packet, so please forgive me. If you guys do have any questions, please just raise your hand, and I'll try to get to as many as possible. So today is more just finding out the foundations of what investing actually is, being able to explain how to get started if you haven't started yet, or just a review of things that you may have forgotten. I became a financial advisor because I, number one, have a passion for investing. I think it's one of the most important things anybody can do. But I also, more importantly, have a passion for people. Growing up, I was always engaging in relationships and trying to find out more about people's stories. So if I could change somebody's life by helping them with finances and learn their story, that's what's important to me. This is also a big reason why I came here to present. I'm not getting paid to do this. I'm not charging anybody to do this. It's just to be able to educate people around the town. One of the big things I do with my clients is I need to understand each of their unique needs, but there's always one process in order to achieve a long-term goal. So that's what we're going to talk about today. I'd love to get started. So if you guys does everybody have packets? Okay. So if you flip to that first page, it's just the foundation of investing. And then at the bottom there, it's going to show what I like to call is my golden donut. And this is our 5 steps for truly getting invested and knowing that you're on the right path. Number 1 is really looking at your financial situation today, understanding and really looking yourself in the mirror and say, what are the things that I'm good at? What are the things that I need to fix? And then number 2 is my favorite part, where we get to talk about where would you like to be? And this allows my clients to start the little dreaming phase. We're able to see, okay, what do you want to do in retirement? Do you want to buy an RV and travel across the country? Do you want to buy a house down the Cape? Whatever it is. And then the 3rd step, I get to go back and do my nerd work behind the desk and really find out if that's something that you can achieve. Can you achieve buying the RV? Can you achieve buying the Cape house? And if so, how do I get there? And it's my job to help people implement a financial plan in order to reach their goals. Number 5 is staying on track. How do we stay on track? We do annual reviews, making sure that we update any changes, anything that's come up in life, deaths, inheritances, whatever the case is. Through my experience of being a financial advisor, I've worked with many investors who have investing goals and needs similar to yours, and I'm confident I can address all of these goals. Our seminar today is going to be designed to help you become a more educated investor and to assist you in working toward reaching your unique goals. As unique as each goal is, the process, like I said, stays the same. Before we begin, everybody has their workbooks, and the first step is ensuring we understand what's important to you. Only then can we work and use our established process and build personalized strategies and the specific actions needed to help you achieve your goals. Over time, through revisiting your goals and risk tolerance, as well as strategies that we've developed to help keep you on track toward your goals, we will be able to achieve. The path that I have mapped on this slide is only one strategy to help you with your long-term goals. This seminar, as with all of our seminars, helps provide information on the tools and strategies that are available to assist you in actually reaching the goals that are personal to you. Before we get started, does anybody have any questions? Okay. I think it's a great place to start a discussion about the foundations of investing is to answer the question, why do I want to invest? Why are you here today? Why do you want to learn about investing? What are the things, maybe Sharon forced you to come, who knows, but why is it that you want to invest? I would love if you guys could turn to page 3 in your workbook and really identify your why it's important to you. It'll be unique to all of you, but to answer that one question, why, is the foundation for the investment strategy that you're going to use in order to achieve your goals. Today, we'll discuss 5 basic rules that make up the foundations of investing, and those rules are developing a strategy, sticking with quality, diversifying, investing for the long term, and focusing on what you can control. There's a number of tools to consider as you develop an overall strategy. By understanding the foundations of investing, you'll be better equipped to choose those tools wisely. For instance, many of you may be investing through your employer plan, your 401k, your 403b, which is a good way to save for retirement. Many companies actually match your retirement plan, as you know, and it's always important to contribute enough to make sure you're getting that free money. Don't leave free money on the table is what my dad always told me. So whenever I saw his change, it was going right in my pocket. Most individual investors make their money over time, not overnight. While their strategies may differ based on their personal needs, the successful investors we've known seem to follow the same set of guidelines as the rules for investing. As is often the case in life, rules are simple, but they're not easy to follow. We'll review some of these rules and how you can consider them as you make investment decisions that impact you and your family. Your investment strategy should be determined by your long-term goals, investing time frame, and risk tolerance. Some of you have the goal to help pay for your child's education 10 years from now. You may also be thinking about your retirement, buying the RV. Whatever it is, you need a long-term strategy. It can be very difficult to stay focused on your long-term goals when there is temporary market decline like we're experiencing now. Or you might find it hard to say no to a new investment that may become popular, Bitcoin, Tesla, etc. As you make investment decisions, your strategy will help you stay focused on the long term, so it'll be easier for you to stay on track and achieve your long-term goals. You can jot down some of your goals on the page 4, I believe it is, and really find out what it is that you're trying to achieve with those goals. Understanding your risk tolerance is a key to developing your strategy. Risk tolerance refers to your willingness and comfort level with taking risk. How is that determined? Typically, you'll be asked to complete a questionnaire. I know every company comes out with them, Vanguard, Fidelity, Edward Jones, Merrill Lynch. Everybody has their own unique questionnaire, but at the end of the day, it's all going to be the same, but you just need to develop your own long-term strategy. Gauging risk tolerance and your potential behavior is important because it's likely your long-term goals will be achieved if you do not abandon the strategy. Like I said, rules are not easy to follow. By finding the right balance between risk, you're willing to accept the returns you anticipate receiving, you'll be in a better position to stick with your investment strategy regardless of what the market is actually doing. Now let's move on to rule number 2, which is quality. As I mentioned earlier, if you get any tips on today's hot investments, the best advice that I could give you is just to absolutely ignore them. At Edward Jones, we're not big on investment fads such as real estate or gold, but that's individualistic to us because we know the process that it takes in order to achieve your long-term goals. When it comes to quality, it can be difficult to distinguish one investment from another. For instance, with more than 65,000 stocks available to trade globally, it can be difficult to choose the right ones just for your portfolio. At Edward Jones, we first filter stocks based on geography, longevity, size, and quality. From that group, we then narrow that down the field by identifying companies we believe has sustainable advantages in their industry. They also have experienced management teams, strong financial positions, and last, we use analysis to determine a fair price for the stock, and then we report it on our focus list. In much the same way, bond quality is an important consideration when it comes to your investments. When you're buying bonds, don't be tempted by lower quality bonds because they're paying higher rates. Along with these higher rates comes extra risk and the possibility that they will not make their interest payments. Be sure to write down in your workbook on page 5 any questions that you have about quality investments, what they may be, whatever it is that's going on in your head. Stocks and bonds are just two of the common types of investments. Extending this focus on quality across all investments is a good rule to keep in mind. Your financial advisor can help you weigh your options of what's quality for you and what should be put into your portfolio. In my experience, investment success depends on buying and holding quality investments in a well-diversified portfolio and maintaining that long-term perspective. Speaking of diversifying, that's what rule number 3 is. Does anybody have any questions as far as what quality is? Please turn to page 6 in your workbook. No single investment performs well under all conditions. If you have a large portion of your portfolio concentrated in one investment and bad news causes its value to drop unexpectedly, your long-term financial security could be in jeopardy. It's important to remember that diversification won't guarantee you'll make a profit or keep you from losing money. Investing does not involve any guarantees. But as I said, diversification can help reduce that risk. There are several layers to diversification. One is asset allocation, which means dividing your money among different asset classes such as stocks, bonds, cash, real estate. And in fact, allocating your investments effectively is the single best step you can take to improve your investment return potential. A major study of the factors that determine financial returns showed that over 90% of the variability of returns is determined by how you allocate your investments. This means the difference in your returns from your year to year is largely related to the asset allocation I just spoke about. As a result, asset allocation has a much bigger impact on your investment success than efforts of trying to time the market. How many of you knew the market was going to drop 2,000 points in the last 2 days? I sure didn't. Asset allocation is also more important than the types of investments you choose. To help illustrate the concept of asset allocation, take a look at the investment pyramid on your workbooks, or on your slide sheets, I'm sorry. So that the bottom part of that pyramid is going to be cash. Next comes income, then growth in income, then growth, and last but not least, aggressive. At the lowest level of that pyramid is the cash and cash equivalents, such as savings account. This money is the money that you keep for day-to-day expenses and can also be money that you set aside for investing. If this money is kept in a savings account, which typically has lower interest rates, you likely won't earn a lot on this money. Banks are usually paying, 0.001%, whatever it is, and you make up a penny over the year. The next level is made up of investments that pay income. CDs, bonds. These investments generally have lower risk, lower growth potential, and relative to stocks can reduce the overall risk of your portfolio. I always tell my clients that the best way to win more is by lose less. Lose less And what I mean by that is in 2008, when the market was down 30, 40%, you'd be in a better position today if you diversified your portfolio and were able to lose 15%. Stocks fall into upper portions of the pyramid. The higher you go in the pyramid, the more your risk level increases. However, it means that potential for greater returns. It's important to make sure that you have the right mix of income and growth to pay current expenses and keep up with inflation. Historically, the average of inflation has been around 3% a year, and at that rate, the cost of goods will double in about 25 years. Does anybody have any questions about inflation? Can you please turn to page 7 on your workbook? The mix of income and growth that's right for you depends on your personal situation, your long-term goals, and your risk tolerance. To find the right mix, you need to look at your asset allocation and how your investments are spread out. Let's explore a little more by diversifying a little more. When you hear about diversifying your portfolio, that means owning a variety of investment types, not being over-concentrated in any investment type based on your risk tolerance and portfolio objective. For example, let's say you want to invest in bonds. Bonds are debt securities similar to IOUs. When you purchase a bond, you lend money to companies, municipalities, states, U.S. government, to finance a variety of projects and activities. Basically, you, as the investor, lend money to the issuer, and the issuer agrees to pay money back at a specific date and time in the future. Your choices generally range from 1 day, short-term investments, to a bond that can mature in 30 years. In addition, the issuer pays interest typically semi-annually or twice a year until the bond matures. Most bonds are a $5,000 minimum and then in increments of $1,000 to $5,000 and thereafter. However, this does not mean that the bond's purchase price is always going to stay the same. Sometimes it will be sold at a premium, which means it is above its face value, or it'll be sold at a discount, which means it's below its face value. In general, the longer the maturity, the higher the interest rate. Longer-term bonds tend to fluctuate more than shorter-term bonds. There is an inverse relationship between bond prices and interest rates, and when interest rates go up, bond prices go down. I'm a big picture guy, so I just picture the teeter-totter, and when interest rates go up, the bond prices go down, and vice versa. If interest rates decline after you purchase a bond, your bond's market value will likely increase. Conversely, if interest rates rise, the bond's market will likely decline. However, the rise and fall of your bond is only important if you sell it prior to the maturity of when you're going to receive your principal back. This can surprise some bond investors. However, no matter how much the price fluctuates on a bond, if you hold it to maturity or till it's called, you should receive your full principal back. Now we're going to move on to stocks. Most of people associate investing with the stock market. So what does investing in the stock market mean to you guys? Would you guys say you have a pretty knowledgeable idea of what investing in the stock market is? You may heard of bull and bear markets. The use of bull and bear to describe the markets comes from the way animals attack their opponents. Bulls, they thrust up with their horns, and bears, they swipe down with their paws. These actions are metaphors for the movement of the market. If the trend is up, it's a bull market. If the trend is down, it's a bear market. When you invest in the stock market, you are buying into publicly traded companies. What are the ways you can earn money investing in stocks? Most people invest in the stock market to earn a return on their investment. Two ways to do this are through potential growth of principal, also known as capital appreciation, and dividends. If you guys turn to slide 9 on your slide sheets, it's going to show you a little breakdown of what capital appreciation actually means. It's the difference between what you pay for a stock and what it grows to be when you decide to sell it. For example, if you paid $20 for a share of stock and then sold it for $30, your capital appreciation would be $10. Keep in mind that stocks are subject to market risk, which means that stock prices can always go down and result in a loss of principal. Dividends are payments given to shareholders out of a company's earnings, usually quarterly, and can be paid in the form of money and company stock. Remember, dividends are not guaranteed and can be increased or decreased or eliminated at any point without notice. Traditionally, some quality investments can make our dividend-paying stocks. These are usually stocks of well-run companies, consistent strong earnings, and these companies seek to reward their investors through dividends. If you guys go to slide 9, is going to show you the difference between companies that did offer dividends and companies that did not. Of course, stock dividends can be an additional source of income for you, but dividend-paying stocks offer more than just income. They also provide the opportunity for growth. As you can see, stocks that historically paid dividends, typically higher quality stocks, outperform stocks that didn't pay any dividends, which is in the blue. Of course, you can diversify your equities or stocks by sector. The stock market returns of different sectors can fluctuate. If you're diversified, those fluctuations may not affect your portfolio as much. Let's review an example of why it is important to diversify. In the 1980s, the technology sector was a great example. There was tremendous growth in the 1980s that was then slumped down with a slowdown in the personal computer business and mainframe markets. In the early to mid-1990s, however, there were major advances in microprocessor technology that gave the personal computer business a big boost. Investors returned to tech stocks. And then, as you guys have experienced, in 2000 and 2001 came the tech bubble, and all the tech prices dropped again. If all your investments were in tech stocks, you'd have ridden one heck of a roller coaster. If you had some tech stocks in some other sectors, your portfolio may have been more stable. We've talked a little bit about bonds, we've covered the stock market. Next, we'll discuss what package investments are, including mutual funds, exchange-traded funds, and unit investment trusts of similar types. But first, does anybody have any questions? So if you jump to slide 12, we're going to start with an understanding of what a packaged investment is, such as mutual funds, exchange-traded funds, and unit investment trusts. Invest in a variety of stocks and bonds, or a combination of the two, so you can receive built-in diversification. When you invest in one of these, your money is pooled with that of other investors. For today's purposes, we'll focus on mutual funds specifically as an example of a packaged investment. It's a good way to diversify by sector and asset class to buy quality professional managed funds. A professional money manager or money management team then invests the money into variety securities to help the fund meet its objectives. So what are some of the benefits of mutual funds? Unlike many other investments, mutual funds is an appropriate investment for large or smaller sums. Here are some of the other aspects of what mutual funds are. How many of you don't know what a mutual fund is or may not understand the concept behind it? All of you understand? Like I said before, it has built-in diversification. Most funds diversify their holdings by a variety of investments that correspond to their category, whether it be income or growth. However, please note that again, diversification does not guarantee or profit or protect against loss. It can just merely reduce the risk that you see when you're in the market. Mutual funds also have professional management. Each fund is run by one or more professional money managers who are responsible for the day-to-day operations and performance. A typical fund engages a large group of research analysts, traders, financial analysts, as well as a variety of other investment professionals. This takes the burden of managing of investments off of you. What are the ways you can earn money from investing in a mutual fund? Some of them is very similar to a stock where it pays dividends. You can also earn interest. The mutual fund will subtract expenses and pass these earnings on to you as dividends. The second way to earn is for the share price of the mutual fund to increase in value, When a mutual fund management team sells a security, the fund at a profit, a capitalized capital gain is realized. Any gains are periodically paid to fund shareholders in capital gains distributions. Now, you've heard me use the word risk a few times during the seminar. You are probably aware that most like other investments, mutual funds carry their own risk. These risks will vary depending on the type of fund, but some general principles do apply. The stocks and bonds owned by a mutual fund may fluctuate in value because of market conditions, causing the value of the fund to fluctuate as well. Because of these kinds of risks, a mutual fund company cannot guarantee results. But one thing I'd like to address is different advisory programs that different firms offer. I know Vanguard, Fidelity, Edward Jones, Merrill Lynch offer advisory programs. How many of you do not know what an advisory program is? Investors looking for a different level of diversification and professional management beyond mutual funds may want to consider this fee-based program. Generally, these programs use investments that have been professionally selected and continually reviewed to make sure they are appropriate for the program. Any questions on that? All the things that we talked about so far fall into the category of buying and holding. One of the core beliefs here at Edward Jones, and that's what we're going to talk about next, investing for the long term. If you all will, please turn to page 9 on your workbook. This brings me to rule number 4, investing for the long term. Remember, your strategy needs to help provide for your family or your families goals not today, but also 25 years from now or more. So many things can change from year to year. That's why it's important to talk regularly and make sure that your needs are being met. If necessary, make adjustments to help ensure that they are. If you receive inheritance, someone passes away in the family. Regular investment reviews are also a good opportunity to make sure your beneficiary designations are up to date. That's one of the large things that happens is when people get divorced, they still have their ex-wife on their IRA beneficiaries, and they didn't realize it, and when they pass away, guess who the money goes to? The ex-wife, and that's not always the best. Let me ask you, even before recent market volatility, how many of you ever felt a little uneasy about the stock market? One person like to say why?
Well, basically, at my age, I'm saving for my children.
Mm-hmm.
I just don't want to, I don't think I have a long enough time frame if it goes down to recover.
Mm-hmm.
But at the same token, that what happened the last couple of days, I'm looking to buy.
Absolutely. Smart man. Over the last 84 years, the U.S. has experienced war as well as economic and political uncertainty and upheaval, especially in the last couple of years. In spite of these setbacks, our nation and our financial markets have always persevered. Even during the 1930s, which was one of the worst decades for stocks, the stock market basically broke even. In fact, in 2009, marked the end of one of the worst decades ever as stocks fell an annualized 1%. Second and only to the decade ending in 2008. However, a difficult 10-year period has historically been followed by strong performance, which is around 13.5% on average per year. Of course, past performance of the market is not a guarantee of future results. If you go to slide 16, I'm going to talk a little bit about systematic investing. You may need to rebalance or make some minor changes to take advantage of opportunities. Opportunities now, like we were just talking about, where the stock market is what I like to call a flash sale. How many of you like to shop? Or how many of you have bought a pair of jeans in the last 5 years? Now, next time American Eagle, Nordstrom has a sale, I want you to go in, look at the pair of jeans, and then put them back down, and come back the week later, and then buy them when they're not on sale. How many of you think that's a crazy idea? All of you? That's exactly the way the stock market is, especially right now, where you have I like to relate it back to a discount. The market is at a discount, so why not buy when it's low instead of freaking out about it? A great way to take advantage of this time in the market is through systematic investing. Although systematic investing does not guarantee profit like they talk about, it does allow investors to buy more shares when the price is low and fewer shares when the price is high. This typically results in lower average cost per share than if a constant number of shares was purchased at set intervals. It is suitable for investors who wish to invest gradually over time and help average out the price per unit. This chart helps illustrate how systematic investing works. These charts demonstrate how you could potentially decrease the average price paid for shares purchased over time rather than a lump sum investment at the beginning. The first example assumes a 5,000 lump sum investment at $20 a share. The second example assumes $417 monthly investment for 12 months at various prices per year. In these examples, the lump sum investment strategy produced an ending balance of 250 shares, each purchased at $20. The dollar cost averaging strategy of investing $417 per month purchased a total of 300 shares during the course of that year at an average price of $17 per share. In this scenario, the investor purchased 50 more shares at an average price that was $3 lower than the lump sum investment. So let's revisit that discussion about bull versus bear markets from a few minutes ago. On page 9 of your workbook, I'd love if you guys could fill out the blanks, and who knows the answer? You did?
You buy more when the price is low and fewer when the price is high.
Perfect. Does anybody have any questions about what systematic investing is? Yes?
So to do this, are you advocating kind of like buying like having it automatically withdrawn from an account? So that
Yes, exactly. So, so every month you take out, you could be similar to this scenario, you would take 417 per month. Instead of saying, you know what, I'm going to save up 5,000 and I'm going to invest it at the end of each year, why not invest $417 per month to make the cost lower? Does that answer your question? Perfect. If you could turn to page 10 in your workbook to make a list of issues that you think or you want to control. And I'd love if one or two of you could share some of the situations you would like to control.
Everything. My husband will attest to that.
Yes, sir.
Well, being at the point of being over 72 with minimum required distributions.
Yeah.
And because of Roth came in somewhere in the middle of my savings.
Yeah.
If I had to do it over again, I would never get an IRA.
Why is
I
that?
would only get a Roth.
Mm-hmm.
And the reason for that is I'm required to take percentage
Right.
out of my IRAs every year.
Mm-hmm. Mm-hmm.
That's being added to my Social Security, it's being added to my pensions, and I'm paying taxes on all those.
Yep.
And it's limited that, not to brag, but I can't go above $85,000 of income in a year,
Right.
because that takes my Social Security from $144 a month to $184 a month.
Right.
So you're kind of limited. So anybody who has an IRA, they should definitely pay the taxes and get in a Roth.
Yeah. Absolutely.
Plus, I can't get fuel assistance because just based on my Social Security, which is like $30,000. Everything else I'm limited from from fuel assistance, food stamp, Meals on Wheels, all of those things are limited.
Right.
Because I was a saver.
All right. I appreciate you sharing that. Thank you. You can't control the economy, but you can control the saving and spending habits so you're more prepared for that rainy day. Similar to what we're having now. While not the most attractive word, budgeting can highlight where you are spending and ways to increase your savings. It's also important to establish an emergency fund. A typical rule is 6 months worth of living expenses to guard against items such as unexpected expenses or job loss. This is just a general recommendation. Additionally, you can control your level of debt. Some debt is necessary for your financial picture. For example, an education, a home, or a car would not be possible for most of us without borrowing. On the other hand, credit card debt can cause financial problems if it's not managed appropriately. You can't control the stock market, but you can control the way you respond when the stock market drops. If you're invested in quality stocks and allocated your assets, you may not need to take any action. Although we can't predict the future, historically the market has rebounded. You may want to use low prices as an opportunity to buy, back to the sale of the stock market. You can't control tax laws, but you can control the way you use tax advantages. This can be done by choosing investments with differing tax treatments. There are 3 general tax categories: taxable, tax-deferred, and tax-free investments. The key differences reside in how and when taxes are paid. Tax diversification may help counter the ever-changing tax environment and help provide for flexibility in retirement. We all know how many times our tax laws change. They're going to change in 2025. You can't control the fact that every investment has some risk, but you can learn about your own risk tolerance. Diversifying your portfolio holdings and taking a long-term view of your investments rather than overreacting to short-term setbacks. You can control the quality of the investments you own, their diversification, and how long you hold them. Anyone can get carried away by emotion. Just don't make emotional decisions where your money is concerned. Can you please turn to page 11 in your workbook? We've covered a lot in a short amount of time today, and I really appreciate you guys bearing with me while I read off of this. It's much better when we have the screen and I'm able to engage with all of you. But I just want to recover some of the rules that we talked about today. Rule number 1 is developing a strategy. Finding out where you are today and how are we going to get to where you want to be. Rule number 2 is sticking with quality investments, making sure you have other people doing the research for you to make sure that you are in these quality investments. Diversifying your portfolio, investing for the long term, and focusing on the things that you can control. At this time, I'd like to open the floor for any questions. Again, I do appreciate your patience. Sharon and I have been super excited to be able to offer these to you, so I just want to say thank you. Are there any questions?
So what are the ways you can evaluate a mutual fund to know whether you're getting that quality or not?
Absolutely, absolutely. My personal recommendation is consult your financial advisor. But if you want to do it on your own, you can start looking at expense ratios. If I was not a financial advisor, and I knew everything about the market, I would go to Vanguard and I'll look at the lowest expense ratios, look at how they're rated, look at how they've performed compared to their peers, and this is all information you can find on your own. Any more questions? Yes.
You talk about not investing on emotions.
Yeah.
But isn't that what the stock market has done for the past 2 days?
Yeah.
How can you control that if that's what the market is doing?
Okay. I'm glad you asked. So, if you are systematically investing, you know that today and tomorrow you're going to be investing no matter what. I had a client, before she became a client, she expressed a situation in 2008 where her advisor pretty much told her to take all of her money out of the stock market at the bottom of the stock market. She has yet since to recover where she was, and that was an emotional decision made from his standpoint, but it's also an emotional decision from hers. So not basing your actions off of an emotional standpoint, and that's one part I love about my job is it's 10% financial and it's 90% being a psychologist. So it's understanding why people want to get out, understanding why people do certain things, and being able to show them, hey, it's not going to last forever. I gave you guys one of my favorite marketing pieces, and it shows what the headlines were each year when the market went down. This really shows the emotional side of how people reacted, and if you stayed invested, where you would be now. So that's one of my favorite pieces. You guys can all take that home. Yes?
I was gonna say, what happened the last couple of days is only a paper loss. It's not a loss unless you sell. Whatever you do, don't get out.
Exactly, and that's another part of not being emotional. It's just, you see red in your portfolio and you immediately want to pull it out, but if you just wait a couple more months, it's going to come back and you technically didn't lose anything. One thing I always say to my clients is that when the market does go down and you want to throw that brick through my window, I want you to attach two checks to it. One, to invest more money, and two, because someone's got to fix my my window. So that's a perfect way of thinking about it. Any more questions?
So like, can you just explain the process of when you, like, so say I call you to be my financial advisor, like what do you just look at? Or
Yeah.
what's the process of it?
Absolutely. So one of the biggest things that I always tell people when they come to my office, you don't pay a thing until you understand what you're paying for. So the first 2 appointments that I do specifically they're complimentary. You give me all your statements, and I'm able to look at what you have now. Then you come in for a second appointment, I'm going to show you what I found, what I would change, and if you feel comfortable, then we move forward to becoming, engaging in the client and advisor relationship. But it's, if some people want to do it themselves, and that's fine. I still say hi to people in the supermarket. Everybody has their own preference for how they like to engage. Does that answer your question?
Yeah.
Yeah.
At one time, annuities were the hip product, and I understand there's a big pushback on that now. It's not really the right vehicle.
Yeah.
Can you explain why? Sorry if I derailed the conversation.
No. It's hard because I can't technically give advice on annuities. Do people need them? If someone was very, very low income and needed income when they're retired, it could be a good strategy. But overall, there's going to be better performance in other areas of the market. So why don't we look there first before we start getting into annuities? I think there's a huge conflict of interest when it comes to annuities, but that's my personal preference. Any more questions? Yeah.
Are you following the market heavily?
Yeah.
What sector do you think is going to respond to the coronavirus best?
The best?
Yeah. Healthcare?
Healthcare going down.
I believe biotech. If you're overlooking that, I think it's a mistake. I'm trying to avoid giving advice. One thing I would avoid is technology. It's performed very, very poorly. One of the things I start talking to my clients about is international high-yield bonds. Those have performed much better than everything else. Some of them are actually up today. The market went down 6%. I think some of them went down, I think American funds went down 2%, and some of them are actually plus 1-ish. Does that answer your question?
You like healthcare?
In certain portfolios, it can be beneficial, yeah. Any more questions? Questions, comments, concerns, emotional outbursts? Yeah.
So if you're looking to educate yourself on mutual funds, for example, where do you go? Where do you look? Do you go to the individual stock pages
Yeah.
fund pages? And
I-
it's just so hard to understand.
Absolutely. Yahoo Finance, Morningstar, I think those are two of some of the best. Hey, you can even pull out your phone and you swipe left a few times and the stock market pulls up and you can click on different stocks and see, what's best. What do you like? What do you want to look at? If you ever consulted somebody like me or somebody else that's in the area, they'll give you a list of mutual funds that they think is good, and most of them will do it out of the kindness of their heart, if that's what you want to call it. Does that answer your question? Perfect. Yeah.
And just a comment for her. Basically, mutual funds have ratings or they have stars. They go 1 to 5 stars. 5 stars is the best. And also there's another chart that will give you a comparison in a grouping like technology. Might be 2,000 funds. It will tell you how that fund is rated. Might be number 25. But 25 out of 2,000, that's still a good fund if it's 5 stars.
That's exactly right. And that's what I was talking about before, about seeing how it performs or how the mutual fund performs amongst its peers. And he's 100% right. It grades each mutual fund on stars, 1, 2, 3, 4, or 5. I try to put all my clients in 4 or 5 star funds, and then they even go even deeper to silver, bronze, and gold. Is that right? So there's so many different areas that you can research on mutual funds and really finding out what would be best for your portfolio. We've covered a lot today. If you guys have any questions or would like to discuss your situation, please indicate this on your evaluation form that I put in there. If there's one thing you do today, it would just, for me, it would just be to fill out the evaluation form. You don't have to talk to me in the supermarket, but this enables me to change what I'm doing up here. It also allows me to see what other topics you guys would like to see, what would be best, what would be beneficial. I offer personal retirement reviews where we can talk about key steps to your financial success for your personal investment goals, or even just going over what's in your 401k, making sure that that's positioned properly for you. I can also provide detailed reports that show you if you are on track for retirement, or if you have a shortfall. In either case, we can design an appropriate strategy to help meet those retirement goals. Likewise, if you do know anybody that would benefit from a seminar like this, I'd love it if you did relay the message to them, and I would appreciate the opportunity to engage more with our community. On a final note, I just want to thank you all for coming. I know Sharon was super excited to do this, and I'm happy to be the source of financial advice. Going forward, we're going to have more professionals come in and talk about their areas of expertise. And they'll be able to provide subs and all that kind of stuff. So I really do appreciate you guys' time. Sharon, do you have anything to share?
So I just wanted to thank Colin once again for coming in and talking with us, and thank all of you for coming tonight. As I mentioned, we will have another seminar on March 31st and hope to see you then. In the meantime, if you could fill out those forms for Colin. If you're interested in meeting with him, he does have a sign-up sheet here. And thank you all. Greatly appreciate it.
Thank you, everybody.